Welcome to Delphos Insights. This is episode 32, where we examine debt raising in emerging markets and what lenders require in 2026. In today's capital environment, securing institutional financing in developing economies is no longer just about the availability of capital, but about overcoming structural misalignment at the earliest screening stages. With AI-driven underwriting now standard, transactions must be built on data-backed, downside-tested structures from day one to avoid immediate rejection. So to really ground that structural shift for you, imagine a profitable, rapidly scaling enterprise in an emerging market.
Right. They've got solid cash flow.
Yeah, exactly. Solid cash flow, strong local contracts. They apply for institutional debt, and within seconds, they are rejected. And not by a human analyst, but by an algorithm.
It's brutal.
It really is.
Yeah.
It feels like we've installed this algorithmic gatekeeper that only speaks a highly structured language.
Yeah.
So we are basically starving fundamentally good businesses of capital simply because their financial data doesn't naturally translate into the algorithm's preferred syntax.
That gatekeeper metaphor actually captures it perfectly. I mean, the algorithm is not necessarily evaluating the quality of the business itself. It is evaluating the formatting of the risk.
The formatting of the risk.
Right. When a business does not speak that syntax, we get a massive macro disconnect. I mean, just look at the formal micro, small, and medium enterprise sector.
Right, the MSME space.
Exactly. The documented demand for finance there sits at 10.3 trillion US dollars. But the available supply is only 4.6 trillion US dollars.
Oh, wow. Leaving a 5.7 trillion US dollar financing gap.
Yes. The capital exists, but the bridge between the issuer's reality and the lender's screening mechanism is essentially broken.
But wait, I have to ask, how does an automated system accurately price the risk of a dynamic, modern enterprise? I mean, if it is just running a generalized screen, it seems like we're comparing apples to oranges.
Well,
Because a logistics firm faces totally different headwinds than a regional manufacturer.
yeah, but the thing is they are not using a generalized screen.
Oh, they aren't.
No, credit committees rely on massive, standardized global benchmarks, primarily the institutional GM's dataset. Yeah, it is this actuarial foundation built on historical performance data from 15,000 loans and 2,000 defaults. And that spans 500 billion US dollars in emerging market debt.
That is a massive amount of data.
It really is, and the AI uses that data set to hunt for very specific structural weaknesses. So if an issuer's financial model does not proactively map its cash flows against the failure patterns found in those historical defaults, well, the system flags it as unpriced risk.
And immediately rejects it.
Exactly, immediate rejection.
So the AI is actively hunting for historical failure patterns. But the current macroeconomic environment must complicate that, right? I mean,
Yeah.
we're looking at a situation where private credit assets under management are projected to reach 2.6 trillion US dollars by 2029.
Yeah, there is a mountain of dry powder.
Right. Yet we are seeing severe liquidity constraints. The IMF is warning that capital outflows could hit 1.6% of GDP in vulnerable emerging markets.
And that tension is exactly why the investment filters have become so rigid today.
Makes sense.
Because lenders have vast pools of capital, sure, but global tightening means their risk appetite has narrowed significantly. To clear the algorithm today, an issuer really must present an independently verified financial model demonstrating absolute resilience.
Right.
Mechanically, that means proving a debt service coverage ratio of 1.3x to 1.5x, specifically under severe downside scenarios.
Let me stop you there because the mechanics of that downside scenario are crucial for you listening to understand. It is not enough to simply show your revenue covers your debt payments 1.5 times over in a normal, stable year.
No, normal years don't cut it anymore.
You have to mathematically prove to the AI how your cash flow survives, say, a currency devaluation or a supply chain shock without defaulting.
Yes, that explicit shock absorption is the exact syntax the algorithm requires.
Get it?
But, if a business's baseline margins are too tight to naturally show that 1.5x ratio under stress, there are structural solutions.
Okay, like what?
Well, issuers can allocate risk through specific financial instruments, like senior secured debt, or by leveraging blended finance to fundamentally alter their risk profile.
How does that actually work in practice, though? If the AI is looking at a strict numerical threshold, how does blended finance serve as a key to bypass that gatekeeper?
It works by integrating specialized, risk-absorbing capital directly into the transaction. Consider women-owned businesses, for example.
Okay.
They currently represent 34% of that micro, small, and medium enterprise financing gap we talked about.
Which is roughly 1.9 trillion US dollars in unmet demand, right?
Exactly. Now, if a transaction is structured to include verifiable impact metrics supporting women-owned enterprises, it qualifies for specialized facilities from development finance institutions.
Ah, the DFIs.
Right. These institutions provide guarantees or subordinated debt that effectively absorbs the first layer of loss.
I see. So the development finance institution takes on the riskiest slice in the deal.
You've got it.
And once that guarantee is plugged into the financial model, the overall risk profile drops, the debt service coverage ratio improves, and suddenly the AI gatekeeper reads the syntax as acceptable.
Exactly. The institutional capital flows because the downside is mathematically protected.
It really shows that raising capital now relies entirely on disciplined structuring and data alignment long before you ever engage a commercial lender. Which is fascinating because it means companies need to architect their capital stack defensively from day one, rather than just pitching a growth story and hoping the numbers look good enough.
That is exactly the shift, which brings us to the core issue every issuer must evaluate. Does your transaction's financial model proactively address downside risks and meet the rigorous, data-driven thresholds required for immediate investment committee readiness?
This has been Delphos Insights. Learn more at delphos.co.